a few perspective, there is more capital than there is deal flow. Rated securitizations, unrated securitizations, multiple banks providing leverage. High net worth investors are actively pursuing deal flow. Yep. They're looking for opportunity. There's so much capital. And so what that creates is this imbalance. And so we're seeing rising defaults, right? So and that's because I think people are willing to chase and do a little bit more than they should, right? So they kind of get over their skis a little bit too much. And, that's a question of how principled are you going to be when it comes to your professional services business. Yeah. So the multiples are not there, right? So the multiples are typically EBITDA, at best, EBITDA times.
Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Thank you for checking out the show. We're doing round 2 with a special guest, Kevin Kim. A lot of people in the industry know him. Nonetheless, if you could, Kevin, thanks for being here. Can you do a little intro on you and your firm and everything going on?
Yeah, thanks for having me, guys. Once again, it's great to be on the show again. For the audience members who don't know me, my name is Kevin Kim. I'm partner at what's now Fortra Law. We were formerly known as Geraci LLP. We have rebranded to Fortra Law. Name has changed. The mission hasn't. So we have the same exact business, same exact partners, minus one, and all your favorite faces and names and people who serve the industry are all here. Just the name has changed. Our website has changed, fortralaw.com, but all the other content and education and legal services are all the same. So
conferences too?
Conferences too, yeah. 2 conferences a year. We rebranded those to Fortra Conferences, still Las Vegas and Newport Beach. But we might be exploring new locations because people seem to be out of love with Las Vegas. So.
Okay.
Yeah.
That's probably temporary, but anyway.
Yeah, it's good to switch it up. I mean, we do live events as well. And, sometimes we used to do all our events locally and people are like, yeah, I'm sick of coming to that same place every time.
Yeah.
But Vegas isn't like, DC or Baltimore though. So
it's gotten more expensive, but also there's no room at the hotels. And it's just, I mean, and people are like, well, why don't you come to Florida? I'm like, well, we'll look at it, so.
Sure. Yeah. This is, it's so interesting because we always talk about the business of private lending, hard money lending, whatever you want to call it, as there's not that much stuff that is changing on a regular basis. But then at the same time, things are changing so darn quickly. So it's like an industry that you look back, day to day, it's like, hey, it's just business as usual. You're kind of just trucking along. And then you look back and you're like, man, a year ago, look at where we're at now compared to then. Things are just changing so much. And I'm guessing you guys have probably seen that with a lot of your different clients, maybe even your law firm you look back and you're like, wow, things are way different than they looked at a year ago.
100%. Yeah. That's the mark. That's why I love this industry so much. It's so how fragmented it is produces so much dynamic change every year. And you have so many different levels to the industry, which is, it creates this really interesting dynamism, and they're all borrowing ideas from each other. We have very introductory new market entrants that are just making their first loan. And then we have, the Kiavis and the RCNs of the world. And because we have the ability to interact with all of them, the market, it's so dynamic, even at the local level. We were just talking about it earlier, right? The deal sizes are getting bigger, and lenders are becoming much more sophisticated in how they operate. There's so many options now. What was once just doing loans at the auction steps is no longer the strategy anymore. And it's just, there's so many different ways to make these loans now. So it's a very, very good time, and it's really cool to be on the battleground of private lending.
I mean, that's one of the reasons why you're a really good podcast guest and host, because you have a lot of behind the scenes dealing with so many clients that lending companies that look so different. Big ones, small ones, this capital structure, that one. And that's kind of where we left off last time. Mm-hmm. So we did this, what we were chatting about before we went live, is that I rewatched the podcast that we did about 15 months ago. And we ended on a really cool spot, which I think will be a good jumping off point. Here's what you said to refresh your memory. We were talking about capital sources. There's a lot of capital in the space, and of all different kinds. Private investors selling to institutional credit lines, all kinds of different stuff. We're going to talk about a number of things. But one thing that you said that stuck out to me is that you said, regardless of what the capital available to you is, don't change your core thesis.
Mhm.
Right at the very end of that podcast. And I was like, damn,
Yeah.
that was a good one. I know where you're going with that, but for the audience, you want to expand on that a little bit?
Yeah.
And then I got a few points there.
Well, this rang true this past year, right? So right now, if you look at private lending and hard money lending, kind of from a 30,000 foot view perspective, there is more capital than there is deal flow. Rated securitizations, unrated securitizations, multiple banks providing leverage. High net worth investors are actively pursuing deal flow. They're looking for opportunity. There's so much capital. And so what that creates is this imbalance. And then you also have the big national shops that are offering really, really attractive opportunities from a capital standpoint, but also they're making it very competitive, right? And to a point where it's hard in some markets to even do fixed income anymore. So, and I won't name them, but they are the nation's largest private lender, and they are able to push leverage much more than most local lenders can and offer lower rates than they can. So what does that do? Well, it creates this imbalance, and you find people, what I would call chasing the dragon, and they want to compete, right? And so they have the ability to use certain types of capital sources that puts them in a competitive footing with those bigger shops. And then they go outside their box. They do loans they would never have done, they would never have done. And they think that, okay, well, like, let me give you an example. Like, clients will say, like, okay, well, I can now sell this paper off my balance sheet, so I don't have to worry about it. Well, and then they all of a sudden take a much more looser approach to the underwrite, and they do things that they wouldn't have done in the past. Like that, I don't know if that's a good idea, because remember that your purchase agreement with that institutional buyer does have what's called a buyback provision. Right? So you screw up hard enough, they can force you to buy it back. And for a long time, we never heard of buybacks being a real thing. Past 5 years, especially past 2 years, it's a real thing, right? So with all the fraud out there, and so that's become the problem. I think a lot of folks are, because of the glut of capital, there's a desire to maintain market share and desire to chase that dragon, and they don't want to lose all this opportunity. But at the same time, I hear the opposite story from my local clients. Local and regional lenders that are principled. Tell me, eventually those borrowers come back, right?
Yeah,
because they're gonna have to come back, because they go shop that low price or that super high leverage, but the service is not there, the execution is not there, the speed of closing is not there, the underwriting is too complicated, whatever it is. That's where I feel like the local lenders can really win in today's competitive market. But they should also maintain principle, because if they want to be around for a while, like if you chase, you're just going to end up another fly-by-night operation. And we're seeing rising defaults, right? So and that's because I think people are willing to chase and do a little bit more than they should, right? So they kind of get over their skis a little bit too much. And, that's a question of like, how principled are you going to be when it comes to your business?
Yeah, so there's a few things to unpack here, and that's why I wanted to start here. And I know it's going to go in a few different directions, but this is a very common topic and question, like with our podcast audience and in our mastermind group. Because, okay, let's back up a little bit and say what we started with: don't change your core thesis. First of all, it's important to have a core thesis.
Oh yeah.
There are some people who got into this business recently, and by recently I mean like in the past 10 years. And their core thesis came from what the capital tells them they can do. And that's it. Here's your guidelines. Go find some deals. And therein lies a gigantic problem, because they did sign that mortgage loan purchase agreement. And you might have to. So like you look at, like you started to say before, a lender might say, look at this deal and be like, I wouldn't do this with my own money. But I can fund this $6 million multi-property DSCR deal with these guys' money, even table fund it. Looks like me, everything's good. I'm making origination fees based on a $6 million loan. Boom, not my problem. Just made a bunch of money. And I get it. I get why people would get into the business and think that and say that and go after it. But they don't realize that if you look at a small shop, a couple buybacks could put them out. Now, I think that the big boys, they know what they're doing. They have loan loss reserves. They're prepared for this. But there are so many lending companies out there, and some people who are balance sheet lenders, which is our mastermind group and our audience, they can't help but look into this stuff. They're like, hey, I can do a ground up construction up to 90% loan to cost, and it's going to be anywhere up to $5 million bucks, and it's not my money. Why wouldn't I do that?
Yeah. And it was really refreshing. I just introducing a client in the Northeast to a client out West. And you guys know how competitive it is out West here. And that client to this day, he's like, we don't do construction. We don't do it. And he's principled about it. Like, he's never done it, never will do it. I'm like, okay, cool, man. And like, he's smaller. He's probably doing less volume than he wants to, but he can sleep at night. And I tell anyone that's kind of on the, if you're not, like you said, if you're these bigger shops, and that's the logic, even the bigger shops, like what we're probably referencing as bigger shops, they complain about like the number one shop saying, why are they able to do that? Why are they doing that? Well, they can absorb the risk, right? They're huge. They're doing $15 billion a year in volume. They can absorb the risk. They've got a multi-billion-dollar cap table. They can manage that risk. You, the local lender, when you have to do a buyback, oh boy, yeah. And if you're having to, even if you're a balance sheet lender and you're chasing and you're having to foreclose and you're not watching the local market's values, we see this in Texas right now, right? You're not watching local values and you overextend yourself. Austin, Texas is seeing that pain right now. So that's one of those things, like, you really got to be smart about your thesis and be principled.
Yeah, we know
long term.
We know a lot of lenders that are very well capitalized, and they tried to enter Texas and they just couldn't because they were disciplined enough to just back off because they couldn't get deals that they wanted at the low leverage. And
Texas became a case study, I think, because like it's the lowest hurdle to entry when it comes to regulatory. You don't need anything there, right? So it's like you can start lending right away, right?
And it's a quick default process compared to
30 days and you're out, right? Real easy. Yeah. But the values, right? They saw this surge post-COVID, and everyone and their mom in the industry started lending in that state, and it became more competitive. Like, this is the anecdote. The pricing in Texas was lower than California at one point. And that's how competitive it was. And so, like,
wow.
And, Texas is not an ideal state when it comes to the way the real estate market works. There's a lot of ebbs and flows because it's all privately owned. And so it doesn't have the same type of infrastructure build that you see in bigger markets. And so it's not a bigger market, but people treat it as such. And it really hurt a lot of lenders.
Yeah, I'm always curious, some of the bigger lenders, what their end goal game is. And maybe they know, maybe they don't know.
Yeah.
I don't know if it's to sell, at the end. Is it to just have a cash flow machine? I mean, I know what the numbers look like on our scale. I mean, we're only, at 55 million deployed a year, but like, I see what the numbers are. And yes, our cost of capital might be higher than some of their other cost of capital, but Chris and I have a good bit of our own funds in these deals as well. And,
right.
It's not like, oh, I'm just going to give the company money at 5%. Right. Like, I mean, there's the private capital world with the actual high net worth individuals. Like, there's a rate of return that an investor wants, or, are they, I feel like a lot of the smaller scale operators, they're looking at this as an investment vehicle and they're looking at this as a cash flow machine. I don't think Chris or myself has ever looked at this as a model to sell. Listen, at the right price, everything's for sale. Yeah. But I'm curious if like that's the number with some of the bigger the bigger shops. It's like, hey, we just need to do volume, and
I think that conversation
and we're a data company
at a certain level, right? So like, yes, M&A is a conversation that is had in our sector, right? So Lima One, was a big like driver of that conversation. When Lima One sold, the first big sale was Genesis.
Yeah.
And so, but you got to think like Genesis, Lima One, these are big companies. And yes, for the larger companies, I think there is a long-term goal for either to be acquired by an institutional investor because they all want their own lending vertical, which a lot of them have now.
Yeah.
Or they want to go public, which is very rare, but there is one or two companies that have done it, not very successfully, but they've done it. And I think for those companies that have chosen that long-term goal, I think that's because that's the only way out because of the capital they've taken on, right? They may have taken on certain kind of PE money or certain kind of VC money that the only way for this to work is to go IPO, right?
Yeah, or sell. But one of the two.
Well, no, because a sale wouldn't work because the way the capital is committed and the way they've inserted themselves in the business, they're not interested in selling unless they get a massive multiple, which is impossible. Okay. So that's the question. Like the multiples really drive because private lending is very similar to like a professional services business. So the multiples are not there, right? So the multiples are typically EBITDA at best EBITDA times 5, maybe. At one point, it was kind of like in 2021, right after COVID, it got a little frothy on the EBITDA multiples, but generally it's like 3, right?
Yeah, and which isn't that much.
Not much.
Not much money. It's not much money compared to what you make every year. So
for most, I would say kind of middle market lenders, right? The objective typically is really just to have to attract a little bit more institutional capital, but that capital that won't necessarily control them. I think that's the thesis today. And so nowadays they're looking for like, partnerships with the larger institutions, an insurance company, whatever, right? A big PE firm, or at the same time, or pension fund, or at the same time pursue securitization. Right now in the middle market, securitization is kind of like this trendy thing they're all pursuing because you see a lot of regional lenders that are very successful pursue them. And so the process is getting a little bit more democratized. And so they're trying, and it brings the cost of capital down significantly, right? So that's, and those guys, their game is literally just do as much volume as possible. I think the long-term game will probably bring on, either get swallowed up by one of the larger outfits or bring on an institutional partner for themselves. And the vast majority of lenders are remarkably young, right? We're not seeing folks having legacy issues. Most folks are looking, they're all kind of, most folks in our industry are kind of in their, 40s to 50s, still very busy, very, very young, so yeah, we haven't seen a lot of the whole big exits just yet. So
that makes sense.
Yeah. Because I mean, the model as it exists today just hasn't been around any more than 10 years. Before that, it was just all balance sheet, and a lot of these things weren't in play. We had an interesting conversation on a podcast a couple months ago with Jack Bevere from Dominion. Mm-hmm. Do you know Jack?
Oh, yeah. It's a friend.
Yeah. Jack's a great guy. I've known him for a long time. Very sharp, and a couple things that we discussed with him. Some of the stuff we talked about before, but one, he was giving us some background on stuff that we don't see, like securitizations, because we just don't play in that space. We've never been near a deal. And he was mentioning some of the same stuff like cost of capital, how much of this securitization is guaranteed by the lending company. What is their risk? What are they buying back? And this is going to kind of dovetail into some other stuff. Like one,
it's not for everybody. There are big shops that are still refusing to do it, right?
Yeah.
Very big shops that are saying that's not for us because they can get better cost of cap. They can get similar cost of capital, not meaningfully different cost of capital, and they're not willing to shell out $1 million or $800,000 to the lawyers. And I'm not a lawyer on these files. I'm too small. The firm, they need to have the ivory tower, big, national law firms do these deals. So those invoices are hefty, right? And then remember, you're also paying an investment banker. So there's a lot, and you have to guarantee the risk. So, it's not for the faint of heart. So it's yeah. And a lot of folks are worried about it, right? They're like, oh, this is just shades of 2008 all over again. Like, I don't know if I go that far, but it is concerning because it's bringing down the cost of capital to SOFR plus like 2.5, right? So it's pretty aggressive capital.
Yeah. I mean, we and other people make comparisons to 2008, and we were in the real estate and lending business at that time. It was right around the time we started HMB. And I agree that it's not the same. And the main reason why it's not the same is because we're not looking at the same kind of real estate market crash. We're not looking at the same kind of values crash. That is very, very unlikely, which was caused by all the subprime and all the over leverage and everything else that caused that foreclosure boom. But that same foreclosure boom, were it to happen again, would bring down all the stuff we just discussed. But fortunately, we're not looking at a real estate market like that. But coming down a little bit back to, the local level and everything else, and what we were talking about before, is one thing that Jack mentioned, which is interesting, and it shows you a bit how he operates, is that he, talking about the capital and how aggressive it is, he realized that, so he portfolios all of his fix and flip, the RTLs, and he sells all of the DSCR. And what he said was he had to put underwriting overlays on top of what these loan buyers will do. And he gave the specific example of 620 credit to 680. He's like, we had to put an underwriting overlay on top of what they'll buy. They'll buy 620, but we know that 620 has a much higher chance of defaulting. So we put a credit overlay of 680 that we're going to sell, because he buys back DSCRs every single month. He's got money set aside for that. He's prepared for that and knows what he's doing.
DSCR is a different market. You can't even say, there's no similarities between RTL and DSCR whatsoever, except for the fact that it's a business purpose loan. So like the capital,
except for the fact that the same companies do both and should know this stuff.
Correct. Yes. That's
how it's relevant to the audience.
It's nascent, right? So it's a new thing. It's only been around for a few years in our industry, but it's a very hot commodity, right? Because the volumes are growing significantly. A lot of former flippers are now landlords. It's a very popular topic. You have to understand it's a full doc. So if you come from the mortgage world, you'll understand this is a full doc loan, right? This is 30-year paper. So this is not stuff where they'll kind of like, futz around with the buyback. No, they're going to force it right away, right? And it's for little reasons like prepayment. So it's a different product.
Early mispayment.
So selling it is not necessarily ideal, my perspective, for the smaller lenders. I tell all my clients, yes. So I tell all my clients, if you're just getting started in DSCR and you're originating this stuff, I don't love the idea of you funding it and closing it in your name and selling it to somebody. I would rather you work with a wholesale platform so that you don't have to worry about as much on those buyback issues, because you're wholesaling it out of the house. You're brokering it basically, right? So that gives you a little bit more peace of mind, because you are probably not as well accustomed to the way the capital works. Remember, short-term paper like fix and flip and construction, it's absent fraud. The buyback conversations are nuanced, right? And a lot of them are discretionary. When it comes to DSCR paper, it's a calculated formula, right? And it's also not just around fraud. There's multiple reasons that are like simple, like prepayment within a certain time frame. So it's full doc. So unless you have a deep mortgage banking background, I would probably start with just brokering it. There's so many great wholesale programs out there, and that will get your feet wet. And you'll start to understand how this works and what the policies and procedures are with the capital and what they're looking for, because it's so different. It's just, and that's what the challenge was in our sector. Like a lot of clients couldn't figure it out because they were just like, this is the polar opposite of what I'm used to doing, right? But the market is demanding it, and I tell clients it's something that you should learn how to do because it's here to stay. It's not like it's going anywhere. But it's harder to learn than it is fix and flip, Go
ahead, Jay.
Is there an industry available stat of the DSCR volume compared to compared to fix and flip?
Yeah, I don't
have
it right in front of me, but
you know what? I
saw
saw something from Lightning Docs, from part of your firm shop that does the documents, an email that came out at the end of 2025 that said unit-wise, fix and flip, or RTL as it's known in that space, and DSCR were about 50-50.
Yeah.
Units.
Interesting.
Just as big.
It used to be that RTL was about, kind of 3 and DSCR was 1. It's like 5 years ago. And that just kept like doing like this.
Yeah. I figured DSCR would be bigger at this point.
I think
it's getting in that direction, right? Yeah. Because the capital that's looking for it is much more diverse, and the product is diverse, is becoming more diverse. because now they're taking on multifamily. Now they're taking on, and the question is, will they take on bigger multifamily? There's a lot of stuff there.
And it's a 30-year bond instead of a 1-year paper. So I think, and I've said this on multiple podcasts in the past, like I think that is an important product, DSCR, because it was way underserved by banks. When we were in the banking industry before HMB and everything else, banks are terrible at rental property loans. DSCR is an important product. Now, are they getting too aggressive? Of course. And that's like kind of ebbed and flowed a little bit in terms of underwriting guidelines. I think that the institutional RTLs are kind of garbage in terms of underwriting, but I think DSCR is important. And we're gonna talk about some underwriting and appraisal stuff. Yeah, where were you on that one, Jay?
Wait, related to what?
No, I think I jumped in when you were talking about something DSCR.
No, it was about the DSCR volume, because from what I see on stats on it, it seems like, I don't know, that it would be significant.
You guys are in a market where it's doing exceptionally well, right?
Got it.
And so you're in your backyard.
Besides Baltimore.
And Philly.
Yeah, that's
Baltimore and Philly. We're going to talk about that. And mind you, like we don't do DSCR ourselves.
Right.
Like our people in our mastermind group ask about it. Should I add this to, like our lending platform? And maybe. And I think that
you gotta learn it. It's not easy, right? So like a lot of lenders they basically said, we don't have the resources to figure this out. We're gonna hire our way through this, because they had no choice, right? So they brought on a former mortgage banking person to do the DSCR because they just couldn't do it.
Yeah.
Right. So, but at the same time, like it's something where my philosophy on this has always been, you have to learn how to do it, but do it slowly, but just broker it, like kind of crawl, walk, run, right? And the only reason why I advocate for it is because it's just a competitive landscape where, like, if you don't do it, that borrower is going to go somewhere else for it, right? And then at the same time, it's a profitability question, right? So you can bring in a little bit extra income for the business by doing it too. So, but the question is risk and underwriting and understanding the product, and so it takes time. It's not for the faint of heart, who just have done like 1 or 2 fix and flip loans. But I think that it can be learned relatively quickly. People are smart; they can adapt pretty quickly. So, like, just learning how to do it is probably the first step.
Yeah, I mean, I don't know if the bank personally. I don't know if the bang for the buck is there. The amount that goes into these files and what you get back in dollars is not attractive to us in our model and our operation. It's not. It's like doing it. I mean, it's like doing a conventional mortgage loan plus a little.
Yeah.
know,
so every market's a little bit different, but some clients are doing it because they want to keep their borrower sticky, right?
Yeah.
Other clients do it because of the economics. Every market's a little bit different, right? So like the Southeast, DSCR is doing exceptionally well. The Northeast is doing just fine. The Midwest is fantastic for it, but you don't see it as much on the West Coast. And so like it's the same thesis. Like, I'm not making any money off this. Why should I do it? The bigger shops are doing it because if I don't do it, my competitor, who's literally a building away from me, is going to take that borrower. And it's so competitive. They're like, oh shit, we got to do this.
Yeah. And they can win on volume. Like if you can do $1 billion worth of it, great. But if you have to spend 5 hours doing a $150K loan, maybe not.
Yeah. I hear your point. Yeah.
So is it not big on the West Coast because the deals just don't make sense? The rental properties don't.
They're starting to. Yeah. So there are programs that have custom fitted to the local needs. The issue is just pure the rents aren't just aren't there. Yeah. But California was once one of those markets where like the joke was DSCR would never work in California, but there are shops, there are wholesale platforms that have figured it out and have been able to offer the product here. Same with Texas. Texas is one of those markets where it never will work in Texas, but now it is starting to slowly, right? But like, for example, in the Midwest, Wisconsin, Ohio, Indiana, Kansas, Nebraska, Iowa, like it's fantastic out there. So, every market's a little bit different.
Yeah, but that's also assuming max leverage, which lending companies try to assume that's the point. Like it might not work at 80 LTV in, San Diego County, but it probably works at 50 LTV. So like but a lot of people assume that it has to be max leverage to make sense, like it does in the Midwest, but that's not necessarily the case.
Well, yeah, but at scale, that's you got to be in a market that you can scale it in there, and the majority of the deals fall under that debt service coverage. In California, if you buy a property for $1.5 million and you can get a tenant for $5,000 a month, it's never, and that's what on average, never going to work. I mean, you're right. It works if you put down, 70%,
Yeah.
But at
That's
scale, I mean, listen, real estate lenders are guilty of this, and real estate investors are guilty of this. They're chasing the highest leverage possible to keep the most amount of money in their pocket and have to come down with the least amount of money out of pocket. Like, that's just what it is. They're chasing the high leverage, and they're enabling each other to a fault. If a
that's
lender
what
is
I
gonna
find
offer
that the smaller lenders are actually thriving right now, is they're being more principled about the leverage they're willing to push.
Yeah.
But they're finding different verticals inside of the product to make that borrower sticky. And this joke about like in a client of mine, I'll give this all the credit to a client of mine. Noah, I don't kick my borrower in the nuts on the underwrite, right? And so that's how they win the business. But that goes to the point, like they come back for that, right? So it stings sometimes when you're small and local, like, oh crap, I just lost my client to XYZ lender who's national. But you have to have faith they're going to come back, because they usually do, right?
They do.
They need you.
I mean, we do lots of loans for borrowers that do 50, 60, 70, 100 deals a year, and we do 1 or 2 of those loans. And we are happy being their backup plan on those 1 or 2 deals a month, or 1 or 2 deals a year. And we're happy with it. And guess what? In the future, we might do 10 deals a year for them as things dry up. I mean,
and that's the longevity issue, right? So like a lot of times the institutions are hot and cold.
Yeah,
are consistent. So
we tell a lot of members of our group, because they get very, very frustrated when they get to like the $15 million in deployed money out there. They get frustrated because people eventually leave them. And I'm like, listen, these big real estate investors, they're going to outgrow your product. They're going to outgrow this one, your product, and that's okay. Give them good service, do a few dozen loans for them, and they'll come back. They'll come back, and they know that
eventually they're going to shop the more aggressive stuff.
They're going to go to Kiavi and get a lot higher leverage and a lot cheaper pricing. And they're not going to like the customer service, but that's okay. They're going to deal with the customer service, because their 50 deals a year is going to save them hundreds of thousands of dollars.
Right.
I mean, let's also keep in mind that a lot of good borrowers just outgrow single family. They're going to move up in asset classes.
Yes.
Fair.
Not any fault of your own, but they're going to start buying multifamily.
Although, what's fascinating right now is a lot of people are flocking to SFR. So
yeah,
I go to these multifamily shows, these commercial real estate shows, because I do real estate work as well for securities. And a lot of them are like, they got their ass handed to them in multifamily.
Agreed.
Markets
right over the past few years,
rough out there, right? And they're like, and now they're doing residential, so it's kind of funny to see. You can see guys leave, and you see guys come back, and it's just really funny to watch.
Chris, you want to talk about the appraisal stuff?
Yeah, I do want to talk about that. So I don't like
you guys are in the market.
No, we've covered a couple times the Baltimore and to a lesser extent the Philadelphia DSCR fraud. So we don't have to dive too much into that, but that's where this conversation stemmed from. I read a couple articles about the AAPL show a couple months ago in Vegas in November.
Yeah.
And on a couple panels, one was the head of ROC, one was the head of TORAC, and the conversation started about the DSCR fraud, but where it ended up was, according to these articles I read, is that there's a fundamental problem with lending in this niche based on appraisals, which is something Jason and I have been saying and teaching in our mastermind group for a long time. Like, this isn't a Fannie Mae conventional primary residence loan. No. It's just not. You can easily do one of those 20% down, get comps from the subdivision, and you're good. Appraisal's fine. Works totally fine for that. It's a different animal, even fraud aside. Fraud's a nasty thing. Like, when you get to fraud as a lender, it's a really, really shitty situation. But even that aside, and this happened to another member of our mastermind group recently, depending solely on appraisals for value can get you in real trouble in this business for a few reasons. One is, if you're doing a fix and flip loan and you don't know the market, you're lending in Chicago, you're based here in DC, you're relying solely on the appraisal, the ARV that comes from that appraisal does not take your borrower into account. That appraiser knows nothing about your borrower, how good they are, what their characteristics are like, cash, credit, nothing like that. It's just assuming that they're going to put out the best product on the block. And part of Jason's job and our other business partners who underwrite constantly is, what is this person going to produce from this property? That's the name of the game in underwriting, right? And so if you take that, the most important part of underwriting, out of the equation and say it's only appraisal dependent, it's really just a matter of time until you lose some serious money.
Yeah. Yeah.
Go ahead.
Go ahead.
No, please.
Yeah. I mean, I think that's right. I mean, we joke about it all the time. If the three of us here are flipping a house, and this is, we're flipping a house, we're all going to sell for different prices. We all have different, different things that we see on there. We all have different experience levels. You might have a $60,000 budget that you're quoted from this contractor. This contractor might quote you a $70,000 budget, and maybe the $70,000 one can't perform and the $60,000 one can perform. Like, it is such a performance-based, individualized business plan, and it is hard. Flipping houses is so hard. They don't know, someone who's flipped 100 properties in a certain zip code is going to have a lot more success than someone who's flipped 2. That's just, but a third-party appraiser with no economic interest, that's hard for them to determine. It's a hard job. It's a hard job to have. And we always have believed that, and listen, I get this. You can't do this at scale when you're doing billions of dollars.
But arguably you can. I don't know. I mean, it's,
my opinion,
like Jack does it at a pretty decent scale.
I have an opinion on what they can do at scale, those lenders. And in essence, you hire you hire a local appraiser, and like, that's their full-time job. Pay them a real salary and be like, hey, you work for me now. You're my eyes and ears in this particular geographic area.
Yeah.
And you're doing every inspection. You're doing every draw. You're doing every appraisal. You're doing every evaluation. If we have an issue and we haven't done a draw for the borrower in the last 45 days, get your butt over to that front door and go on and see what's going on in there. And like, they're boots on the ground, and it's a grinding position. I think that's really the only way to do it. Like, you go meet with the borrower. Like, we meet with every borrower. We have to. We can do that because we do 200, 250 loans a year. Like, I can't do that if we did, 2,000. But I can do that at this level.
This is the same. I mean, the people were whining about this and crying bloody murder. I think this is probably 2015. So a year after I joined the industry, there was the national conversation had just begun, and commoditization and, like turning this into conventional mortgage or something like that. And there was a lot of those conversations. This industry can't be commoditized. And then the counter argument was, like, law of large numbers, right? You're going to have the bad things happen. Okay, so what can we do to mitigate those bad things from happening? We can't eliminate them altogether, right? So you're always going to have law of large numbers dictate you're going to have something go wrong. It's going to happen, right? So, but on the appraisal front, right, this is something that can be mitigated very well. And I think that this is one of those things where this is vendor control. If your business is revolving around needing appraisal, okay, I get that. Okay. And not every client of mine requires appraisers, but if you're going to require appraisals, you should have an understanding of how dirty the appraisal market is, like the industry is. Like, I used to be a former banker. I've said this on stage. I don't trust the majority of appraisers out there, right? Because when I was a loan officer at a bank, I don't know how many appraisers try to bribe me, right? So and there were loan officers that got caught at the bank that I worked for to be taking bribes from appraisers to use them, right? It's like, I do not, that's just ethics 101, right? So, and you see this in conventional all the time. What number do you want? Magically, the number doesn't appear.
Yeah, what do you need? What do you need to make this work?
Right. So, and it's not like, okay, so there's the question of, okay, we have to do this at scale. Well, yeah, you have to use national appraisal shops that have access to every market. But do you have a gut check to that? Do you have a way to gut check that? And the market is so diverse. There are shops that they're national, they're big, but they're also local, right? They have offices in every single locale. Their appraisal team is solid. They don't take that kind of risk, right? They have a person that works for them. They have a local person. They have a crew of people that go walk the properties. They have multiple means of checking that appraisal because they have. And nowadays, there's no excuse. There's so many great options now. Like, I really tell everyone, like, even Richer Values, like, it's a fantastic platform if you want to use it as a gut check, right? Because I'll tell you, it's probably more accurate than your local appraiser is going to be, right? Especially if they're aging out. So, there's some truth to this stuff in the technology out there. Then also comes to the thing of local knowledge and local, what do you call it? I guess tribal knowledge even, right? So when all this fraud happened in Philadelphia and Baltimore, and we saw the similar issues in North Florida, like the local lenders were all joking about this. Like, man, you guys should have saw this a mile away. We would have seen this problem a mile away. We know that property ain't worth that. Like,
that's right.
No, nothing in that zip code's worth 400.
100%. And that goes to this question of, okay, so we always, if you go to any mastermind out there, they always say real estate is local, right? So like, well, if real estate is local, why isn't the lending business local? And so that's a really, and if you look at our friends in conventional, while they may have, like UWM is a national machine, but they have local shops, right? And so like you need to have some type of local presence. So I give a lot of credit to our friends over at Renovo. They have offices in every single locale they're in. They've got they got a head of a person that heads up them a local market. He's from that local market, and that's why they've been able to do so well without having to face as many headaches as others have had, because they have that local presence. And so that's I think that you have to be willing to bite that bullet at scale. And if you're not, be ready for it. It's like, and the problem also is like they're blaming the brokers. I'm like, really?
Yeah, blaming the broker.
Really? Are we gonna blame the broker? The broker's job is to get this deal done. He's gonna come hell or high water. He's gonna figure out a way to get this done, right? Because his paycheck depends on it. You really think his incentive is to protect your interest, lender? No, it's not. So like,
no, of course not. It's to get a commission. So like, this kind of comes back to part of the whole point of this business, in that you can run this as an investment vehicle or you can run this as a mortgage company. They are both available to you. We said this before, and we hammer this home in the mastermind group. Most of our people, and us included, we run this as an investment vehicle. If you're running it as an investment vehicle, which is smaller, more profitable, what it's supposed to be, has a limit in terms of how much it's going to scale, then you're the underwriter, you're the risk manager, you're the one with the economic interest, so you set the values. If you want to run it as a mortgage company, that's available to you too. It's a different way to make money within the same industry. And then roll with the appraisals and everything else and the scale and all the stuff we just talked about, and hope it lasts. Have a good run. Put away a lot of money.
Especially longevity is there, right?
Hope it lasts.
Yeah, well, that's the thing. Like, if you look at the mortgage banking market at large, a single blip in interest rate, and our industry is not as extreme as this, but like if you try to translate mortgage banking to our industry, it doesn't make a lot of sense, because a single blip in interest rates, a single blip on Wall Street in the bond market can cause massive hemorrhaging in a non-QM business, particularly, right? You see a lot of those guys just shutter overnight because capital markets took a dump. So yeah, I agree with you. There has to be some level of, I guess you can call it, nimbleness to your business. There are very few that didn't suffer when at the national level when that happened, but there are ones that didn't, and they didn't scream bloody murder because they were able to mitigate their risk, but because they had the infrastructure to do it, they had the investment made in the company to do it. And so, it tells you that, like, I think the true part of this business really goes back to people, relationship, and local. Like, if you're not investing in that component, you're gonna have to face the reality of these issues. Like, it's just not gonna go away,
right?
Because this is not something that, like, when the whole appraisal fraud happened, like, it wasn't news. It wasn't like shocking to me, because like in commercial real estate, it happens all the time, right? Like, we've gotten appraisals back and phase ones back that were completely bunk, like and you knew it. Like, you're telling me the property has no contamination and there's a gas station not 100 meters away? What? Like, come on. Like, so there's, and because they're trying to figure out how to make their money. So you have to have that. You have to come into it with a little bit of skepticism and protect your business. But they're so busy doing their thing, and the law of large numbers, right? So they get pushed.
It's the law of large numbers, skinny margins.
Yeah.
I mean, here's the other thing that I've always been confused about. What even happens is, like, let's say you have a $500 million fund, and then you can't, all of a sudden production's going down and down and down and down. And you're like, man, I'm getting all these payoffs and they're not supporting the new loans that I'm writing. Like, what happens? All of a sudden I'm, covering my fund service, pref debt service, however that's set up. and I only have $400 million deployed, not $500
Yeah.
million deployed. Like we've only seen things go up and up and up and up and up now. So
Well, I mean, that's kind of a good problem to have. I would like clients of mine that have that problem. They're like, okay, well then we'll just pay off some investors.
I
Right?
mean, if they're
not the end of the world.
disciplined enough to do that, or if they're disciplined enough to do that, because then it's like, well, we got to cut employees.
Yeah.
Because
So there's sponsors that will overdo it.
And then they'll start doing worse deals. They'll be like, hey, let's go instead
They'll
of
start doing the
LTV, let's do a 90
deals.
LTV. We already see this.
Chase.
We've seen this happen on a smaller scale. And I'm like, listen, like if you have a bad month, you have a bad month. Like you can't just, just because you have the available capital sitting in your account doesn't mean that you can, change your underwriting.
If you're going to be chasing, then yes, right, agreed, right, and you over levered your infrastructure and you overdid all that and your staff, and for sure, right. The funny thing is that at the fund level, like that fund level, we didn't see a lot of these woes caused by the appraisal issues and the fraud that came out of that. It was really the pain points were by the big national aggregators and institutional shops. And that has more to do with most debt funds are not national, right? Most of these funds are regional at best.
Oh, for sure.
Yeah, and so they're still doing traditional underwriting when it comes to like valuation. They're not checking the box on just getting that appraisal from an AMC and moving on. So that does, and they're not, and their broker relationships are a lot more tidy, right? They're not as broad. So but to your point, Jason, like there were funds through the past 3 years, and they are in hot water, and the majority until last year were in commercial, and this past year we saw some hits in residential. And yeah, I mean, part of it had to do with doing bad loans because they were in a competitive landscape and they didn't want to let go of investors. They didn't want to pivot. So
I mean that is part of this world. Managing risk, managing your capital, there's financial risk associated with it. These are all factors that we have to juggle. Not easy. I want to switch gears a little bit before we wrap here, and I wanted to hear some of your plans for 2026 in terms of a firm and a professional and everything else, and then also some predictions if you want to throw out a couple.
Well, so predictions wise, I mean, we put it pretty publicly at APL. Nima and I do a kind of a what you should be thinking about for next year, right? So prediction wise, I think that securitization is not going anywhere. I think it's going to continue. I think we'll start seeing the first kind of headaches that come from that because securitization has a reinvestment period. So those loans come due, pay off. You have to refill that bucket. So we'll probably start seeing the first woes of the glut of securitization, but we'll also start seeing more of it next year. More rated deals, so that the bigger shops will be able to execute on rated deals. I don't think defaults are going to slow down. I think defaults are going to kind of stay static for a little while, which is, that goes to if you're local or if you're regional or if you've got a debt fund, like, opportunity strategies might be my opportunistic strategies on, on distressed debt might, the old stuff that you used to do back in the day might be something that you want to think about doing. DSCR is going to continue to grow, and it is what it is, right? And it's going to continue to grow. I don't know about any meaningful failures next year because capital is still very frothy. I think that it's going to be more challenging for the middle market players. The local smaller shops are going to do just fine. It's the middle market players that are going to struggle.
That makes sense.
And then, I think product wise, so we already saw this past 2 years. Clients are starting to diversify again into different asset classes. And so, and because their borrowers are. And so I think that's going to continue. More and more of our clients are doing multifamily. More and more of our clients are doing unique stuff in rental construction. So I think we're going to see a little bit more of that this coming year. I don't think leverage is going to go down. I don't think conservatism is going to come back when it comes to underwriting. I think it's going to stay pretty static. Which is great for the local shops. I think the local shops are going to win on volume. I think we're going to start seeing some interesting volume changes in different markets. Like my concern is that, suddenly we're going to start seeing some increased volume in tertiary markets, or what was once considered a tertiary market. but yeah, I mean, that's kind of a prediction wise. From a law firm standpoint, we're gonna go, like, one of the things that we're really focusing on this year is because the rebrand, right? We want to go make sure we go back to basics and we really double down on who we are as an organization, and that means we're redoubling our efforts in customer service, redoubling our efforts in education. We're initiating a bunch of kind of new market entry education and acquisition plans, because like I said in the last show, I think people forget this market is not necessarily dominated by the big nationals. 80% of the national volume is held by the bottom, like not top 10, right? So they only have about 20% market share, right? So that's a reality of this industry because of the fragmentation, right? I'm personally going to be spending a little bit more time in the commercial world because a lot of our clients are asking for it. So more securities work and more kind of profile building in that world, because those clients are coming back to the table in that world, and we're starting to see new shops being stood up in that world. So I think we'll do a little bit more effort there. So that's what we're working on here as an organization.
No, really cool. Really cool. Looking forward to 2026. I appreciate you taking the time. And I know that we didn't get to licensing, but licensing is a constant, source of questions and everything else. And that's part of your practice too, right?
Yeah, for sure. Yeah. We do licenses in all 50 states, primarily in our industry, but we've done it for for consumer shops who do like the bridge stuff. Happy to introduce you guys to my partner Jen. She runs our licensing desk. We've done a bunch of webinars on it. It's still woefully misunderstood in our industry, even by the big ones.
Hence so many questions we get, right?
Yeah. Unfortunately, it's a very weird web of exemptions and definitions and analyzing, but we've gotten it down, and so we can talk about that on a different show. But for sure, and we've got a bunch of episodes of webinars on the topic. So if your audience wants to learn more about it, our webinars are really good.
Yeah, I was going to say maybe we can link this show to the last one we did because we talked about licensing. Any major notable changes over the last year? Because I think that's when we talked about it.
From a licensing standpoint, well, so Florida is always going to be the thorn in our side. They're going to constantly try to change their licensing regs. Thankfully, for now, they've got a conservative governor, and he's not going to institute new licensing rules probably. One meaningful thing we're pursuing is we're trying to loosen the hurdles to entry in Utah, because the hurdle to entry is that lending manager, you have to have like consumer lending experience, verifiable consumer lending experience in residential. That doesn't translate for our industry. So we're working with the commission to try to loosen those and create a meaningful pathway through, but not eliminate completely. So they are happy. No, I mean, I don't really see much on that side. There's interesting deregulation coming in the securities world, but that still hasn't been telegraphed yet. The commission's just getting their sea legs right now. So I expect them to be coming out with new rules this year, especially revolving around tokenization and cryptocurrency and exempt securities and all that. So we'll probably see something there. You guys will see it from us because we're following that very closely.
So if anyone from the audience wants to reach out and talk about, licensing work with your firm or securities stuff, how can everybody find you?
Our website's the best place, fortralaw.com. They can email me. It's pretty easy, k.kim@fortralaw.com. Just Google Kevin Kim. Private lending, you can probably find us that way. But yeah, website, fortralaw.com. It's got all of our webinars, all of our articles. We're also on YouTube, so you can find those videos on YouTube for the webinars. But yeah, we're pretty easy to find on the internet, and hopefully, we can answer the questions.
Very cool. We appreciate you taking the time as always. Good talk. Another good talk today, huh?
I appreciate you having me on.
Good stuff. All right, everyone. That is it for today. That is the pod, and we'll see you here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced Private and hard money lenders.